What up? What up? What up? Hey guys, it's your resident online mortgage lender, Robert Lewis, NMLS license number 180100. Hopefully, this video finds you doing well today. I am going to, who I want to speak to is anyone in the state of Texas that's considering being a home owner in 2023 and is classified as a first-time homebuyer. And if you don't know the definition of that, don't worry. We will get into that here momentarily. But that's who I am attempting to speak to today. So is what I would say the second most significant barrier to first-time homebuyers. To be honest with you, anybody trying to buy a home, even second or subsequent buyers. But again, for the focus and context of this video, we're talking about first-time home buyers in the state of Texas, right? So the second most significant barrier, as I said, is affordability. Number one will be the down payment and closing costs, okay? So, and that's as of the recording of this video, 2023 January, okay? So what I want to do is I want to provide a solution in the form of the mortgage credit certificate that's offered by, in my opinion, the best down payment assistance program statewide from the state level in the state of Texas, and that's TSAHC, the Texas State Affordable Housing Corporation. That's what that acronym means. So without further ado, let's talk about what an MCC is, a mortgage credit certificate. Okay, glad you asked. So an MCC is simply this. It's a program. Okay, first of all, it's a tax credit. That's what it is. Mortgage credit certificates, tax credit program that was established back in 1984. This is not new. Okay, so this was established as a result or a part of the Deficit Reduction Act, okay, back in 1984. And the goal of it was to help states convert a portion of the federal funds that comes down from the federal government and allocate those funds via a private activity bond, right? PABs. And those PABs are used to help people with that affordability piece that I was speaking of, right? So that's what a mortgage credit certificate is, okay? It's a tax credit, right? Now, let's move forward. Mortgage credit certificates, they're issued by what we call HFAs, housing finance agencies, okay? And some nonprofits, okay? So housing finance agencies are the ones that get these bonds, okay? And their mandate, again, is to help low, moderate, and first-time home buyers offset a portion of the monies, the amount that's owed in the form of mortgage interest, right? So whenever you buy a home, you have an interest rate, you have a principal amount, and it's going to calculate a total amount of interest. Well, what these tax credits allow you to do as a first-time home buyer, and that's key, I'm going to say that throughout this presentation, is it helps you or allows you to take a portion of that interest that you're paying, but convert it into a credit. And credits are much, much, much better than deductions, okay? The lowering or the lessening of your income to the tax rate or tax bucket that you might fall in. Both great, but if you're given a hierarchy between a deduction and a credit, you always want credits. Just like if you have the choice to get a grant opposed to some type of a silent second type down payment, grants are always, because it's free, right? You don't have to pay it back at all once you meet some minimum criteria. So in essence, that's what those tax credits have been designed for. So again, this is not Johnny come lately. This is not new. It's been around forever. Unfortunately, a lot of people don't know about it. When I say a lot of people, a lot of professionals in the lending space don't know about it or don't care to let their buyers know for whatever reason, right? Let's move forward. So as I said before, The mortgage credit certificate, aka MCC, is not a tax deduction, but it provides a dollar for dollar tax credit to recipients to increase housing payment affordability. Again, second most daunting task hurdle for those looking to get into a home, especially in these times, is affordability. Again, this is something that helps to that end. Okay. So that's why they were designed. Let's move forward. So now, unlike down payment and closing cost assistance, which are good, right? The mortgage credit certificate program generally does not restrict the type of mortgage financing, nor do you have to use it in combination with any housing finance agencies down payment assistance program, right? You don't have to, you can get a regular FHA, VA, USDA, or conventional loan as long as you meet the criteria. So again, everybody, in my humble opinion, if you're a first-time home buyer, you need to get the mortgage credit certificate if you qualify. Okay. It's a no-brainer. It's free money. You have to be a first-time home buyer, right? So let's define, okay, what a first-time home buyer is in the context of using this program. Okay. So let's see here. Mortgagors, that would be you, someone looking to buy, right? The mortgagor gets the door. The mortgagee takes the fee, right? That would be us. So you applying for, excuse me, anybody applying for a bond, down payment assistance, or a mortgage credit certificate cannot have had an ownership interest in a principal residence at any time during the preceding 3 years, ending on the date that the mortgage executed, right? So if you executed a mortgage today, whatever today's date is, 3 years ago, tomorrow, and you sold it 3 years ago from the day you executed it, tomorrow you would be a first-time home buyer again, if that makes sense. Okay. Now, even if you have a spouse, okay, and any other adult named on the deed of trust, right? They must meet this first-time home buyer requirement. So if you have a spouse and they're not on the loan, right, but that's their primary residence and they're on the deed, then they're not a first-time home buyer. They would have to meet this requirement as well, right? Now, if you're a married couple, each spouse is treated as holding, as I said, an ownership interest, even if the one of the other spouses is not on or listed on the deed, right? So married couples, each spouse is treated as holding an ownership interest, even if not listed on the deed of trust, okay? Now, there's exceptions to every rule, okay? And so now we want to talk about some exceptions to the rule of what a first-time home buyer is, right? So now, if you're someone, any person who is not a spouse, okay, let's say you're a parent. I think of a situation where we had a brother and sister, okay, sibling, and the sister is not on the loan. She's a co-signer, right, for the brother. So they're not living in the home and they have no interest in the property. They just own the line for the debt, okay? Or a guarantor of a promissory note not secured by the mortgage, but who does not occupy the property. That's an exception to that rule. You would be a first-time home buyer, okay? If you're buying in a targeted area, okay? If you want to know what a targeted area is, reach out and we could help you along those lines that kind of get an idea where that would be. You realtors out there, that'd be something great for you to know. If you are a veteran, you served, you honorably discharged, that's an exception for you as well. So anybody buying in a targeted area, or if you are a veteran, a qualified veteran, okay, meaning a person that's a veteran defined by 38 USC section 101, and you've not previously obtained a loan by a single family mortgage revenue bond. You haven't done a bond loan before. So Again, not only do you veterans get veterans and qualified military members have the best home loan, but you get perks, man. Membership has its privileges. I'm not mad at you. That's why you shouldn't let anybody talk you out of your benefit. You earned it. Okay. Now, I would be not credible if I didn't give you guys, as we wrap up, the full story. Right. I'm a believer, and the scriptures tell us that we should consider the full matter. So, as with everything, there's pros and cons. And my job is to explain to you, lay it out, and let you decide. Because once you have the information, you should be empowered on how to make the decision, right? Or at least to know which direction to go in. So, what are some potential cons with a mortgage credit certificate? I'm glad you asked. It's called a recapture tax. Okay. Now, a recapture tax is a portion of the mortgage credit certificate benefit that's subject to recapture by the Internal Revenue Service, the IRA and the S. Right. I got a lot of y'all hung up. Y'all got nervous when we said that, right? Don't worry. We're not doing nothing wrong. Now, if a recipient meets all three of the following conditions. So there's three conditions, and they all have to be met before recapture consideration is even at play, right? So now, number one, the first thing that must happen is you must sell the home within 9 years of purchase. So this recapture period potential happens within the first 9 years, year 5 being the most expensive time that you might have to pay back some monies if you meet all three criteria. But after year 9, it's done with. Okay. Number 2, you, the borrower, earn significantly more income. Okay. Significantly more income than when you purchased the home. And that's based upon the program maximum, or the income for the program at the time that you did the loan. Okay. And then let's move forward. You as a borrower will not meet the conditions for recapture unless you earn, right, the maximum income limit that would have applied when you qualify for the home and the size at the time of purchase. And it must be compounded from that time annually by 5%. A lot of y'all hadn't gotten a raise in 20 years, right? It just is what it is. Nothing that you've done wrong. It's just, what it is. So you have to sell before 9 years. Okay. And number 2, you have to have significantly more income, 5% compounded annually, right? A year. And then the last thing is this: you have to have a gain. You have to show a profit. So those are the 3 conditions. And then let me digress. This profit that you have to show, that's after expenses, right? Expenses when you sell a house and things of that nature, whoop-de-whoop, yada, 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 right? So only borrowers who meet all 3 of those criteria will be subject, okay, to the recapture. If they sell, give away, or dispose of the home after 9 years, none of the recapture is applicable to you, right? And then lastly, what is the penalty? The maximum amount of the recapture payable on the sale of the home is the lesser of 6.25% of the original purchase price balance of the loan, or 50% of the gain. And you know what? Here's the deal, guys. If your income has been increasing 5% every year from the time that you got in, right? And you moved the property before 9 years, right? And when you sold it, you made a ton of money. It's just right, man. Because again, who are these mortgage credit certificates designed for? They're designed for low, moderate, and first-time homebuyers that have a daunting task trying to overcome the barriers of affordability and down payment. So, hey, if you went in like that, pay the man. It's not a bad deal. But what we're talking about is now. So as we get ready to round up, I just want to admonish you again, don't wait. You got to get in the game. Okay. There's a lot of moving parts that have been put in place the last quarter of last year to deal with affordability for student loans, for conventional loans for first-time home, any type of first-time home buyer, especially if you are at or beneath 80% of the area median income. And to boot, everybody shook. You don't buy when everybody's buying because the prices is running. And all joking aside, rates are going to come down even more. Okay. And guess what's going to happen? A lot of people that are on the sideline going to jump right back in, and these prices are going to start running again because there's a shortage of inventory. I don't care what YouTube tells you. Consider the source. Okay. This is what we do all day, every day. So schedule a consultation. Hit the link, schedule a consultation. Let's have a conversation so we can point you in the right direction and help you achieve your real estate, your home goals for 2023, right? Now, I don't ask this, and that's what the analytics say. Subscribe, guys. Hit the notification bell so that when we come on, right, at least you're notified when we come on. And we're trying to grow the channel to get the message out to more people. I like to keep a good thing to myself sometimes as well, but I'm learning, right? Sharing truly is caring.